Hi guys, welcome back. Today you'll be getting a full breakdown on these 3 methods on how you can get started with investing in very small amounts of money. You can just have like $100 or $100 per month in terms of budget, but nonetheless getting started makes all the world of difference. So today the main concern is how you can get started with investing and yet be very time efficient. Since it's a small amount of money, you shouldn't be spending too much time in deciding or analyzing the investment options. The main thing is get regular disciplined savings. Make sense? So each of these 3 methods actually help you achieve it. If this is the topic that interests you, continue watching on. The first idea is actually to buy shares through regular investing programs, and the first idea that I can share with you today is the OCBC BCIP plan. I'll actually leave links below just in case you want to find out a little bit better about this program. Now this program has certainly many benefits. The first one being, just in case you're aged 30 and before, you actually enjoy this 0.88% in terms of buying and selling costs, because OCBC is really subsidizing this trading cost for you. And for example, if you are investing $100, all you need to pay in terms of charges is just 88 cents. Now, if you're above the age of 30, then the natural fees apply of $5 per counter per trade. But OCBC BCIP is actually a very simple program whereby you can get invested into blue chips. BCIP is Blue Chip Investment Program. And these blue chips, if you look at the list, which I'll pull out over for you to quickly see, this list is about the biggest, best blue chips there is in Singapore Exchange. These companies include SIA, Singtel, Keppel Corp, DBS, OCBC. These are blue chips that certainly you may know them a couple by heart. And when you invest in blue chips, it's very simple and very assuring, because you're not speculating too much onto some company that's unknown, that's going to go bust. These are companies, and blue chips by definition, which I'll pull out for you to quickly understand, is companies that are more than 5 billion in terms of capitalization, which means typically they've been around the market for quite some time. But nonetheless, blue chips still carry risk. When you invest into shares, you're concentrating your risk to one company. Even though it may not go bust, a blue chip can still do very poorly in terms of performance for a prolonged period of time. An alternative for regular share investing can be found in PHILLIP's Share Builder Plan SBP. And this plan, there's a slight difference. You get more counters to choose from, not just blue chips, but in addition a few other counters, and total number of counters are up to 34. But the main difference is this: when you buy through the Share Builder Plan, there's some dividend handling charge which you should take note of. It's 1%, or at a minimum of $1. And there's also a slightly higher charge of $6, and there's no incentive for those who are less than 30 when it comes to this regular Share Builder Plan program by PHILLIP Securities. Now, as you see, regular investing through shares actually have this $5 or $6 in terms of brokerage costs. And this $5 or $6 actually is 5 or 6% of your first $100, which is actually quite expensive. In addition, this does not even factor in the selling portion of it. When you actually sell these shares, you actually still incur brokerage costs again. So in total, the brokerage cost when it comes to small size investing into shares is actually quite expensive. That is why I strongly consider this second idea over here, which I have for you. Second idea is to do regular investing into funds instead, and there are 3 main companies that offer that. First one being IFAST through Fund Supermart, the second one being AVIVA, and the third one being PHILLIP Securities. These 3 platforms allow investing into funds. You can actually set up your own regular investing program in any of these 3 platforms. Alternatively, you can actually look for a qualified financial advisor to help you set up one. But there's actually some slight differences in terms of fees, which I should share with you over here, because I work as a qualified financial advisor. When you do it yourself, you set it up yourself, the fees are usually between 0 to 1%. On the other hand, through an advisor, the fees are usually a bit higher, can be 2 or 3%. But a qualified financial advisor should help you analyze your risk appetite. A qualified financial advisor should help you select funds to help you achieve your financial goals, because selecting funds is crucial towards the performance. Before I show you some tips on how you can actually select funds for yourself, I'd like to invite you to smash the like button below so that we can reach more people together and join our community to become more financially savvy. I have a previous video that I've actually spilled some secrets on how to actually select top quality funds for private clients. I'll pull up for you to quickly see over here. I actually manage more than 6 million worth of asset under management, and within that, I've actually used certain principles to narrow down funds that, for example, have outperformed the benchmark, funds that have shown superior active management, and funds that are diversified to reduce risk for you while trying to get that same return. These are principles that I've used to actually manage private clients' money, and that video certainly will address that question on which fund you should actually select for yourself. The third method you can actually invest your first $100 per month is to actually get into endowment plans, also known as savings plans. Typical savings plan design looks like this. Save $100 a month or less for 25 years, and by then you will have a 30,000 pot waiting for your retirement or waiting for your dream holiday. Now this is a common pitch from an endowment plan. And while endowment plans have certain pros and cons, the first thing that is very clear is when you invest with an endowment plan, it's actually a low risk investment. Do not expect more than even 4% per annum rate in terms of total returns. But on the other hand, your capital is largely preserved if you actually hold to the maturity. Because there's so many plans in the market, Grace has their own plan, Prudential has their own plan, AIA, NDC, all have their own endowment plans. What I'll be sharing with you is what not to look for in an endowment plan. The first thing to take note of is don't choose 25-year saving plans because simply the returns are usually quite poor for a 25-year plan. In addition to that, you realize that 25 years in premium payment is such a hassle. You likely go through life changes like marriage, kids, or even moving house. And 25 years premium, that is just going to overlap into so many financial life changes, and you don't want that to become a burden. You can actually look for plans that actually allow you to pay premium within 15 years or even 10 years, and those plans actually make it a lot easier for you to do financial planning with. The second thing I'd like to suggest to you is not to choose plans based on total returns of non-guaranteed, of course. When you choose plans, look for those that have higher guaranteed amounts. Let me illustrate this to you. Assuming plan A gives you 0% guaranteed return but up to 3.5% with non-guarantees. Plan B gives you 1.5 guaranteed but only up to 3% with non-guarantees. Which should you choose? Naturally, the answer is Plan B because in the past, insurers have actually cut down before on bonus rates. In the past, insurers have actually not fulfilled fully on their non-guarantee projections. So when you choose a plan, prioritize those that give you a higher return. Choose the Plan B, 1.5% guarantee and up to 3% with non-guarantees. That makes you a lot more assured because at the end of the day, endowment plans are meant to be a very low risk first layer of safe investments that you should have. And the third suggestion I have for you today is to actually convert your plans to a yearly mode. Assuming now you buy an endowment plan that is $100 a month, my suggestion to you is to eventually convert it to a yearly mode because that saves you $20 or $30 in terms of total premium each year itself. Your total premium instead of $100 a month will be $1,170 per year. That'll be like a rough illustration. So again, these are 3 points on what to take note of, especially what not to choose in an endowment plan. If you're looking for a quick summary, I have it for you right now over here. In this quick summary, you'll see some names I mentioned such as OCBC, BCIP, as well as funds where you can actually look for them. And in this summary, I also highlight the pros and cons for you to quickly understand what you should be looking for. And without further ado, if you have further questions, leave them in the comment sections below. And I also have a further video for you. This video, how you can invest your first $1,000. This video has a lot more investment details, and I think it's something that's going to address your questions a lot better also. So with that, I'll sign off. I'll see you there. Take care and goodbye.